inhale for shout. Okay? Shout it out. All right, fraud auditing.
Okay. So, let's talk about fraud. We've already talked about fraud. So there's two types of fraud that talks about fraudulent financial reporting and misappropriation of assets. Misappropriation of assets is the one that's more common because it's more employee, lower level employee based, but fraudulent financial reporting is the one that causes the bigger issue. And then, so for most fraudulent financial reporting, it's about earnings management. Most companies try to overstate their income by either overstating their revenues or understating their expenses, but there are cases that are talked about in the book, like the E.F. Hutton case about them actually wanting to understate their income. And then there's something on page 335, the little box up at the top, that was a study done by the Committee of Sponsoring Organizations of the Treadway Commission, and it said that 347 alleged cases of fraudulent financial reporting occurred here in 1998 to 2007, ranging from about $25 million to $400 million of overstatements. So I thought that was kind of interesting. And then a little bit further into that box, it said that 89% of the fraud involved the CEO or the CFO, compared to 83% in earlier periods. So that's kind of why they make
being done by people at the top. And we're talking about why they fraudulent people. Even if people at a lower level commit the fraud, they're being directed to by people at the top. Pressure to look good. Massive egos.
Okay. So then there are three conditions for fraud, and this little diagram is on page 336. If it's at your leisure, if you want to look at it.
And we already did this, didn't we?
Yeah, I mean, this is basically a review of everything we've already talked about, so sorry. So the three big reasons for fraud are incentives and pressures, opportunities and attitudes, and rationalization. So then it just goes more into depth of what those three are. And then there's a box on page 337, that's this box right here, and it's just the reasons people give for why they commit fraud. So the biggest ones are doing whatever it takes to meet whatever goals that management sets, as well as seeking some form of personal gain, versus a lot less of it being lack of understanding of laws. So then there are examples of risk.
Go back down for a second. Why would they, on the top two, which is obviously the biggest reasons why people do this, seeking personal gain, you're going to get a bigger bonus, you're going to have a bigger, your stock options are going to be worth more, whatever, right? Both. And pressure to do whatever it takes to meet goals, well, I think that's the same thing. Maybe it's self-preservation, pressure to meet goals, like you get fired if I don't meet your expectation. It's still, taking care of yourself. And then personal gain is, I make more, so I'm stealing that way. But either way, it's theft, right? But it also can be poor management for people above them, right? If you have compensation systems that are only based on meeting expectations, right? Stock price. You get a certain stock price for me, you're rich. You don't get the stock price for me, you're fired. Really? And there's so many factors going into that other than what those managers are doing, right? So it's an awful lot of communication. Plus, stock options is amazing. You guys can study stock options a bit now, right? 313, right? Stock options, if somebody's got a stock option, they can make far more than their salary, whatever it is, if they've got a nice stock option package. And it's a way companies buy CEOs and CFOs and other executives. They get them for cheaper than market rate, right? They could demand a high salary, but they give them really nice stock options. Well, then what's there going to be a tendency to do if they don't really make the market price that they want? Oh, they're cheap, right? And they get there anyway. So it really backfires.
If you look at this, what I thought was really interesting is only 20% of people said that it was for fear of losing their jobs if goals were met. So it's not so much of like being afraid of that. It's more just wanting to look better and
Get promoted, be famous,
yeah.
cover a business week. Not kidding. Done a product for that.
So then, these three risk factors apply to both fraudulent reporting and for misappropriation of assets. But for misappropriation of assets, it's more placed on incentives and like opportunities for theft versus like attitudes. So this slide comes from the box on 336. It's at table 11.1. For the bottom section is where these bullets, like these examples of incentives, come from. And then the same thing with the opportunities and with the attitudes. So for
This is where they got those test questions that put in. How about that?
Well, that's not.
They're all pretty easy.
So one of the incentives that it talks about, like in the paragraph, not so much in the table, is about the incentive to meet analyst forecasts or benchmarks, which is like what Keith was talking about before. You want to meet like those goals that are set. So that's why you would be more than likely to like overstate your revenues or understate your expenses. And then for opportunities, it said that the risk is greater for companies and industries where significant judgments and estimates are involved. So if you work in a company that's more driven on like depreciation or different ways of valuing inventories, it's more likely that there's going to be more fraud in that department because it's just easier when there are estimates to just fudge the estimates or like your cutoffs for things.
You add the pressure to do it, so you get the incentive to do it, and then you add the opportunity by having lots of estimates in your statements. Right? Your profitability can really be dramatically adjusted by estimates you make up. You're right, inventory, receivables, warranty, things like that.
And then the big thing for the attitudes and rationalizations that the book talked about was the third one, with management having a practice of making overly aggressive or unrealistic forecasts, but also for like it says like in the book, if a CEO or other top managers display a significant disregard for financial reporting, then it's more likely that it's going to occur. So it's basically like do what management does. Like if management doesn't really care, then why would we care? Especially if it's the higher ups, like the CEOs.
A number of years ago, before the stock market big dip, so before 2008, when I was teaching executive MBA, and it's been a number of years, folks from companies we all know all over town, major corporations, would be in the executive MBA program, and they were talking about how much return you had to have on investments they were making. And the numbers they throw out would be, 15%. You had to get a 15% return or you could not get it funded. I'm talking about people like GE, right? You have to have a 15% return on your investment project or they wouldn't fund it. Well, how do you get a 15% return out of investments, appliances in that business or in most businesses? 15% return, really, on all your investment projects? Risk-free plus risk premium, right, guys? Risk-free was pretty low, so what must they have been investing in? Would have had to be high-risk projects, but they weren't really high risk, and they told us that. No, they're not really high risk. We just make it look like they're going to be 50%, fully developed that way. But if we don't make it look like they're going to do 15%, they won't fund it. Unrealistic forecast, right? And then what tends to happen, once you have committed, sort of, to hitting this benchmark, even though it's unattainable, now there's pressure on you to do what? Well, you said you were going to do it. Come on, deliver. Right? Plus, maybe on yourself. You start believing you can actually do that. So I'm telling these guys, well, 15%, what are you guys investing in that's going to earn 15% on every single investment? There's nothing that does that that's of a reasonable risk level. Right? Certainly not at a GE, a fully diversified company like that. And not in the appliance division. Right? Maybe in the jet aircraft division. So it's across the economy. Then the attitude is the overly aggressive and unrealistic. The rationalization is everybody does it. And we got that too. Well, if we don't do this, somebody else is going to do it, and I won't have my projects funded. If my company doesn't lie in my financial statements, I won't have any shareholders. They'll go to the companies that do lie in their financial statements. And it sort of happens. You know, the company after company after company are kind of, they don't say they're cheating in their statements. They don't say it's fraudulent. They don't even say it's earnings manipulation. It's earnings enhancement. Doesn't that sound better than earnings manipulation or fraud? Yeah. So it's kind of this group thing. You know, well, you know, everybody does it. If everybody does it, it must be.
Okay, so then these are just more like the same three factors, but geared towards misappropriation of assets. So, like I said before, misappropriation of assets is usually done by like lower level employees. It's not so much like higher up management, although it does occur. So the big incentive for misappropriation of assets is some type of like financial obligation. So if you are an employee who is experiencing some extreme debt or like gambling issues or something, you're more than likely going to be susceptible to doing misappropriation of assets versus if you're somebody that's comfortable in their financial life and happy. And then also like adverse relationships between management and employees. If you really like your management, you're more than likely just going to just take a few dollars here or take a piece of inventory here versus if it was somebody that you really truly respected your management. And then for opportunities, it said that like weak internal controls create the opportunities for theft, but also like separation of duties. So if you're somebody that's in charge of the receiving and the processing and the holding, and if you're in charge of the whole process or even a significant portion of a process in a company, then you're more than likely going to have that temptation of taking something because there's not somebody coming after you that's going to be looking at what you did.
From the last chapter, what are the four things? You get a lot of things to know because I don't know my testing in the CK. And plus, you want to know it. What are the four things that we try to separate in internal control? You were just talking about recording, right? Doing the accounting, doing recording. What's that? Approving transactions, right? So you shouldn't be recording it if you're approving it. Yeah, separate. Okay. What else? Monitoring and custody. Custody down there, right? Custody of the asset. Right? If you have custody, you don't authorize transactions related to it. Right? If you're recording it, you don't authorize. So have custody. You got the idea? They're all separated. And then monitor, right? Outside independent monitoring, maybe independent or internal auditors, right? Okay? Or just manage some other management that's not doing the approval process. Okay?
And then the book said that fraud is more prevalent in smaller business and not-for-profit organizations because it's a lot harder for those companies to have separation of duties. So if you are in a place that has only 5 employees, you're going to have a lot more responsibility than if you're in a place that has 100. And then
a lot more opportunity. Is due.
And then the attitudes and rationalization is basically just kind of the same as before. Like if management has an adverse opinion towards something, then you're more than likely going to do it. And then there's something in the book, it says like if management cheats customers through overcharging for goods or engaging in high pressure sales tactics, employees may feel that it's acceptable for them to behave in the same fashion. So that's another case of like do as management does and follow the leader basically.
Tell them at the top, right? Whatever example you said is what you're going to get.
So auditing standards provide guidance for auditors in assessing the risk of fraud. And the big thing is auditing standards state that in exercising professional skepticism, an auditor neither assumes that management is dishonest nor assumes unquestioned honesty. So it's like you're neither for them or against them. You have to question everything that they do, but you're not out to get them. But you're also not really there to like promote what they do. And then that also kind of goes in play with like management too. Like you have to be skeptical of your employees as well. If you want them to be successful, because if they're successful then it's helping you, but at the same time you need to be aware that employees are likely to commit fraud sometimes, so you can't be too close with your employees and employees with management, vice versa. So then this is on page 341, and it's the sources of information to assess fraud risks. And then the book just kind of goes more into each of the 5 of them. So communications among the audit team. It says that auditing standards require the audit team to conduct discussions to share insights from more experienced audit team members and to brainstorm ideas. So you really just want to make sure that you're in touch with your audit team, as well as if you're a new audit engagement member, like you want to be in contact with some of the ones that are more senior and have dealt with this company before, or have just been on audits in general, because it's going to give you more ideas on what to look for, as well as how to handle issues. And then it gives like 4 different things that you should be like brainstorming ideas of how to address. And then for inquiries, I wonder if this goes into it. No, okay. So then for inquiries of management, the auditor has to make inquiries about fraud, and management is supposed to respond to them. So you can really just kind of judge the way management responds to the questions about whether or not there is potential fraud. And that also puts some of the responsibility on management of determining if there's fraud. Like they should be going through the day-to-day operations and knowing their employees to determine if there is the risk of fraud. And then it also goes with management has to tell the auditor and the audit committee about any like potential fraud, so that way the audit committee knows, because if you find fraud, you're supposed to report it to whoever the next higher management is, and then if that doesn't work, the next higher, so you don't go straight to the top, but you also need to make the audit committee aware of any fraud that you discover as well. And then for like risk factors, the existence of fraud does not necessarily, like fraud risk factors doesn't necessarily mean that there is fraud, but that just increases the likelihood that there is fraud. So if there's something that like a fraud risk factor appears, then that's something that you need to focus more on, specifically if it's a specific area of the audit that the risk factors are higher, then you need to devote more attention to that. And then it talks more about analytical procedures and what you should do, and it gives the examples of doing like horizontal and vertical analysis, and then comparing those percentages to prior years to determine if there's huge fluctuations, and then if there are, then that's a possibility that there is fraud, and you need to inquire further about that.
Procedures, you think?
Hmm?
When are you doing these particular analytical procedures?
You should do these books.
Yeah, when are you doing it? The ones where you're assessing projects. Yeah, it's during the planning phase before you got it, right? This is early, at least early in the audit. This wouldn't be substantive testing, right? You're not you're not trying to do substantive testing on any balances, right? You're still looking sort of at control, I suppose, right? Just when you're relating to risk. When I was working at Dwyer Country Coal, after I'd been teaching at Central Washington, I went back there for doing some work with them, and I was working, I guess, as a manager still, and running a few engagements for them. And I worked with land development, and we were doing a review, and it was really late in the evening, and people would pretty much disappear. There'd be very few people left around the office. Just the audit, or the review team rather, would be there. So I'm there with maybe, I don't know, 3 staff or something with me. And we're sitting around having this conversation in one of the offices. And we didn't, and I'm asking whether or not the president of the outfit, who also owned the stock, was a crook. Was a land developer, after all. They're all a little shaky. Yeah, but anyway, kind of. And not all, but a lot. It's just kind of the nature of the business. They're wheeling, and so they have a tendency to borrow from new projects to finish old projects. He actually had borrowed from a project to build his vacation house up on the side of the mountain, ski house, ski chalet. So, I mean, there's stuff like this all the time. Anyway, which is not illegal. It's But anyway, but he was making money, and his projects were kind of okay and stuff. So you know, he deal with this. But anyway, he happened to walk by out in the hall and stopped because he had come back from someplace and stopped and listened to me talk about whether or not he was a crook. So then everybody laughed at him. I was walking out, and I walked past his office, and I saw the lights on, you know. So I went in and I said, "So Larry, you over here and you have a conversation?" He says, "Yeah, so you think I'm a thief, huh?" You know, so anyway, so we had a little conversation about what you do. This is audit environment, but a review environment, kind of the same thing, really, in a lot of ways. You're just not collecting evidence. And then later he hired me to be his financial vice president. Yeah. He knew if I was going to watch him like that, I'd watch everybody else too. But he didn't really trust me. I'm not sure he was all that trustworthy. Yeah, he was kind of was. Yeah, so he'd listen to you when you suggested that, you know, that's over the line. Let's knock that off. Gonna get in trouble. Yeah, it's the way you do it. Yeah. So you actually do have these communications. It's really fun. Did any of you guys have any of these conversations when you're out there? You sit down with were you there during a planning phase or something? No? Did you get to sit in any planning meetings at all? Or they just have you do test of details all the time? and well, also test control, which is good experience. So nobody has a story. You will, trust me, very early in your career. You want the youngest staff people to join in those conversations. You guys won't have anything to say, but you'll have a lot to learn. You listen to the seniors and the managers, maybe even a partner, and sit around and talk about whether the level of integrity declines, right? Where are the risks? You're really worried about this or not? And that professional skepticism is really big. You were right. I would not have a client I did not trust, but I always maintain professional skepticism. Because I trust them doesn't mean, you know, they wouldn't lie or couldn't develop a personal problem because of fraud. Right? You know, it doesn't work that way. So beware of getting too close. That's true. But don't be mean either, or serious. Have fun. Have a good time. Always enjoy yourself. Clients enjoy having you around. So just maintain your professional skepticism.
Then there's just a box. The box on page 343 just is the managing the business risk of fraud, a practical guide that the American Institute of CPAs created. And it's just 5 different principles, so you can look at that. So the documenting fraud assessment, these are the things that auditors are required under auditing standards to document. So it's any discussions among the team, procedures performed to assess risks, specific risks, and the audit response, reasons supporting conclusion, results from procedures performed, other conditions and analytical relationships, and natures of communications. And then after you identify and document any of the fraud risks, then you need to evaluate any factors that reduce the fraud before developing an appropriate response.
So is this going to be narrative, flow chart, checklist, schedules with numbers all over them? Maybe all of the above? Could be. Although flow charts don't usually would fit too well. But yeah, could be. Lots of it's going to be narrative, right? But also the analytic procedures are going to be numbers. They're going to be doing number crunching. Yeah. And checklist isn't bad here either. Works pretty good. Same sort of deal with internal control checklist, right? Have the conversations first, then do the checklist. Go back for more conversations. Do that. One other thing. With documentation means that you put something in the work papers, right? You document it, you write it down. If you do not document, you did not do. Everybody hear that? If you don't document it, it's assumed you didn't do it. So you can spend all kinds of hours and not write anything down in the work papers. And you say, oh no, I did that. Everybody's going to say, clearly you didn't. Right? If you ever end up in court, guess what? You didn't do it. You got a peer review. You didn't do it. You can't say, oh, I did it, I didn't write it down. Right? Don't do that. So we're real sticklers about getting your initials or your signature everywhere it needs to go in work papers. And every single schedule, get your initials on. And you date when you did the work, right? And every single one. You write your conclusions on major work schedules that you're working on. And Same thing here. This has got to be documented. So remember, you're charging people for your signature on a piece of paper. Actually, two signatures, two different pieces of paper now, right? The public company, because there's the internal control audit, the financial statement audit. But you're charging for two sheets of paper. You better have something to back that up. Collecting the evidence is doing the work. Documenting the evidence is writing it up, basically, in all sorts of different ways. But writing skills are really pretty important here. You guys figured that out? They were out there working? You wrote some memos, huh? You know, wrote some notes on, even if you're doing a schedule that's got a lot of numbers all over it, bank reconciliation or something, there's still a lot of writing in there, and quite a bit. So you better be able to communicate. So writing skills are critically important. And certainly verbal communication skills are. We just bullshit for a living. Is that true? Yeah, Dr. Klein, doesn't it? A lot. He's talk. So, anyway, yeah, go ahead. Good.
So management is the one that's responsible for implementing corporate governance, and then the guidance developed by the AICPA is the 3 elements to prevent, deter, and detect fraud are culture of honesty and high ethics, management's responsibility to evaluate risks of fraud, and audit committee oversight. I think this goes into it. So then, like, cultures of honesty and high ethics, like, obviously, if you have a company that has really good ethical standards, has a good code of conduct, and is very honest, you're more than likely going to reduce the amount of risk for fraud, because if you're in a more honest environment and everybody's working together, but you also have a set like guide of things of what to do in certain circumstances, then you know like what you should be doing, and you're gonna feel a little bit more responsible if you do something wrong, versus if there's like no code of conduct and there's not really any ethics practice, then you're gonna feel like what you did isn't necessarily wrong. And it's something that the higher up management is responsible for setting, but they also have to like live those lifestyles, because it's like if you're expecting me to be ethical and follow this code of conduct, and but you're not doing it, then what's the point? So it's like leading by example. And then as well as like creating a positive work environment. So if you like the people you work with and you don't feel stressed out every time you go to work, then that's going to reduce fraud risk, as well as with hiring and promoting appropriate employees. You should have effective screening processes, so you're not hiring people that are unethical or seem kind of sketchy. Like you're hiring people that seem like good, ethical people.
I mean, how many guys you have, your seniors, 50 or whatever. Have any of you had your employers, new employers, ask you about anybody else yet who's maybe younger than you? Yeah, already. What do they want to know?
Stuff that's not on a resume.
Yeah. What are they looking for? By the way, they don't care if they got drunk at a party. They're a bunch of CPAs. They don't care if, you know, well, they don't care what their religion is. They don't care if they're religious or not. And it's not that stuff, right? What do they care about?
Ethical employee working.
And do they work their ass off? That's one. Which is ethical. If you don't work hard and you are being paid well, you are stealing your salary. That's unethical. I firmly believe that. I'm sorry. It really pisses me off when people get really high salaries. What? How did that happen? How did you get in that position? And I don't think they're lucky. I think they're just dishonest. I do. And they're stealing their salary. They're not delivering. So they're looking for people who are going to really work, right? And so the work ethic part of it is ethic. It really is something. And then also they want what? You know, are they kind of shady? Right? Do you trust them? You know? And then do you enjoy working with them? But a lot of enjoy working with is what? They work their ass off and they have high integrity. You know, I don't really care too much about what somebody's personality is like or what their style is like or any of that stuff. I care about what they get done. You know, and I don't want it to be obnoxious to be around, of course. But, you know, on the audit teams you were on, were there some people that were, I don't know, more jovial than others.
Okay.
And some that were a little more quiet, to say the least, right? All of the math, right? And you got all of them?
So I asked on that. So like at POC, you get like reviews from like everyone on your team, and you get them like
All reviewing each other.
yeah. Well, they like you review people like below you. So like for me, everyone on the team
Yeah.
contributes to my review, and I think I had like 5 or 6 of them. It's like they're being pushed to get constant feedback. And one of the clients I was on, like everyone was really joking. Like, and I sat in the room with everyone that was like below managers, a senior, experienced, and associate, and
That's an
interns. So it was like everyone was pretty joking. Like I obviously liked that environment. That played in my personality. There was one girl that had a tendency to get offended, and like the biggest negative feedback I ever got was based on her. And like I didn't realize at the beginning that she wasn't as like appreciative of the environment. And so I learned obviously that you have to be careful with that.
It wasn't all men except for her, was it?
No, there's
Oh, good. Good.
yeah, there's 3 guys, 2 girls in the room, but then our senior manager was a female as well,
Yeah.
and one of the managers. So.
Yeah, you have to watch for that sort of thing.
But yeah,
See,
so I guess
people can,
connect with
you know, you guys might have noticed I can be kind of abrasive sometimes. Yeah, yeah, no, yeah. You know, I say what I think a lot. And you can get yourself in trouble with that. You know, and I also tend to, I like to have a good time, so I have fun of everything we're doing while we're doing it. There's some of that too about it. Some people that are a little more serious about things get it.
and I didn't get her the right number of Chick-fil-A sauces one time.
I did what with Chick-fil-A
I
something?
didn't get her the right number. She requested a specific amount, and I was a couple short.
And she wasn't just pulling your chain, she was
No,
serious.
she was serious.
Oh, wow. Oh, wow.
Yeah.
You could just be glad that you're not married there.
Yeah.
See, look at that one. And there's always a silver lining. Yeah. But you know what's fun about it is you will work for people. You guys have this experience. Did anybody work for a senior that kind of drove them up the wall? Anybody have that experience? Yeah? You had that one? And she's saying, yes, one. And did anybody work for a senior that was just a hell of a lot of fun? You wish you could work for them all the time? Yeah, everybody gets that, right? So you're going to have this stuff. But you do with clients, too. When I was at February and Colson, they'd have me get rid of the clients they didn't want anymore. It's hilarious. They'd send me out to the clients. They said, they're not going to put up with you, you know, because I wasn't going to put up with them, you know. And so a client you don't want anymore is one that costs you more money than you make. You know, you're billing them, but they don't ever want to pay the bill. They're complaining about the number of hours you took to do something. And then you're worried about their work anyway, right? Their level of competence and their level of integrity and the whole thing. And so it's a gray area, you know, everything's not cut and dried like it looks in these books, right? You know, we're making a little bit of money off of this client maybe, and they don't look like they're real unethical, they look like they're probably okay, and, you know, but then it's not, but I don't like to do that. If we're not, I don't want to have a client that is difficult to work with, just a pain in the ass. I don't want that in the first place, much less if they're not profitable, and I find they usually go together. They're obnoxious, and you don't make any money off them. So why would we do that? So they'd send me out, and then I'd raise the fees on everything, you know, because, well, we need to justify a higher billing rate because these guys are a little more difficult to deal with, we tell them that. And then pretty soon, fire us, walk away, right? Yeah, because I set it up so we were going to make some money. And plus, my billing rate was higher, so if it's discounted, it was automatically going to be higher. And then I demand that they give me things and stuff like that. So, yeah, there's room for everybody in this mix, you guys. So, that's fun. So tell us about the senior that drove you crazy.
Sorry?
Tell us about the senior that drove you crazy. Just one.
He was just, I don't know, our personalities weren't meshing. He was just very bland. And like, one instance, he said something and I asked him to repeat it, and he said it word for word, and I wanted him to like rephrase it, and it was just, we just went around in circles. I felt like.
He thought you were hard of hearing.
Yeah, I was like, what do you mean? And he would say it the exact, like word for word. I'm like, okay.
So how?
That's what I did. I needed to go to, I actually went with my manager more than I went to him, just because he was so annoying. But I think the senior, like, makes or breaks your team.
Oh, yeah. They're the center of the work, aren't they?
Yeah.
There's no doubt about it. They're running the managers, kind of. Because the managers are working on a whole bunch of engagements at once, the seniors working on fewer. And on an individual day, the seniors only working on that one, right? Because the manager's doing a whole bunch of different things. So they're trying to get the manager to come and help them, right? I have to have questions answered. I need you, right? I need you. They're calling them all the time, emailing and ringing them, and they get a meeting once in a while. But you live with the seniors. So how long did you work with this fellow?
3 weeks. My first 3 weeks was with him.
Oh, really? How many people have you engaged?
It was actually pretty large because they were considering an IPO. So we had a lot of people.
So the senior had several staff.
Yeah.
Oh, that's good. Interesting.
Okay, so then,
Does that have to do with rock?
second, management is responsible for identifying and measuring progress, taking steps to mitigate any identified risk, and monitoring the internal controls that do prevent and detect fraud. So that's where I was saying before, management needs to be skeptical of their employees. You can like them and you can trust them, but you just need to not be too friendly with them because they might necessarily take advantage of you. And then with mitigating fraud risks, management is responsible for designing and implementing the programs and controls that mitigate the fraud risks, and then changing any business activities that are easier and more prone to fraud. Then they're responsible for updating those procedures or just changing the activity in general. And then they also have to monitor those programs that are preventing and detecting fraud. And then the management committee oversight. So the audit committee has primary responsibility to oversee the organization's financial reporting and internal control processes.
So who's on this audit? Who's on the audit? Okay, they're not part of management. So when they say they're independent directors, they're independent members of the board of directors, right? So it's the committee of the board of directors. The board of directors, of course, is elected by the shareholders, right? Can management be on the board of directors? Absolutely. And often major shareholders, they would be on the board of directors. And even if they're not on the board, the CEO, probably the CFO, would be there, right? At the meeting, and maybe leave when they take votes and things like that, or talk about them. That'll happen. Okay, but the audit committee is a group of shareholders who are board members who have nothing to do with management. That's what we mean by independent, right? Okay, they have to be independent. What's that?
They understand.
Oh, and they also have financial accounting knowledge, so they know what they're doing. So who's going to hire the auditor? They are. Who's going to deal with the auditor on every really important issue? They are, right? Okay. What if top management is doing something illegal or unethical? There's earnings manipulation. You got an audit committee who's not a member of management, right? And they don't report to management, obviously, right? Okay, that's the idea. And in a non-public company, that's a real good idea to do it that way. Last thing you need is the CEO to be on the audit committee. What a mess.
So then the book says that PCAOB Standard 5 requires the auditor of a public company to evaluate the effectiveness of the board and audit committee as part of the evaluation of the operating effectiveness of internal controls. So they need to basically just make sure, consider the independence of the committee. If the committee is a little too friendly with management, then that's something that they definitely need to report on, and not just to the committee.
Carolyn said several times about don't get too close to your employees, right, and subordinates. But that doesn't mean don't be friends with. It doesn't mean, but you're professional friends. You know what I mean? You don't. It's good if you like the people that you work with, that are working for you, or you're working for them. But you maintain a certain professional distance, I suppose. You know, and human beings being human beings, you don't always do that. But being auditors, be very, very, very careful. You can destroy your career. And and you can destroy the other person's career too that's working inside the company. If they are in a significant financial position, they're the controller, right? Did I tell you guys yet that I had a friend from high school who he went in the military and then so he went to college later than I did because I went straight in. But anyway, he went through 4 or 5, 6 years later, something like that. But he went to work for Pricewaterhouse and ended up getting the controller for one of his clients pregnant. And nobody knew they were having a romance. Suddenly, they're having a baby. And he was still working on the audit. What do you think? Did I mention this to you? What do you think happened to both of their careers? They both got fired immediately. Not because they had sex, that's okay. Not because they weren't married when they had sex, who cares? But because both of them compromised their integrity and their independence. Oh my gosh, what a mess. I just couldn't believe it. Now, he's still a CPA. Nobody took his license away from him. He runs a one-man shop. He runs his own firm, and he's perfectly happy. He certainly has more money than I do, right? So he's fine. And, they had the baby, never got married, so he's got a daughter, and that's a good thing that came out of it, so all that's fine. But that's probably not the person that he should have had a child with, and her with him, right? You just imagine this environment. Now, what if it's somebody working in the firm with you? A coworker. That is just fine, except what? Well, no, one of them doesn't really have to leave. It's okay, but they'll probably want one to be in tax and one to be in audit. If you're dating somebody now, or going to marry somebody, and you want to go to work for the same firm, you both happen to be accountants, right? What do? You go to work for the same firm and put you in one in tax and one in audit, probably. Right? They're not going to put you both in audit. Why not? They can't assign you to the same audit. Oh, it's a real pain. It's a real mess. But it's worse than that. What if you start dating somebody that is at your level? Right? Most of you guys are single, right? So you go to work, you start dating somebody that's a new staff person just like you. What happens when she gets promoted and you don't? And now you work for her. Or vice versa. Right? So then one of them, you don't get fired. What do you end up doing? One of you leaves. Almost always. It'll change your career. So I'm not discouraging that. It's okay. You're going to move different jobs anyway. It's all right. But, oh, by the way, if you start dating somebody you work with, tell the partners. Don't be secret. Because if you're working on an engagement together, and now you're involved with each other, you got to know. That's the whole workplace, right? Be careful with this crap. Just be selfish. It'll be fine. Works better. Too many people in the world.
Okay, so these 3 slides are just elements of a code of conduct. This comes from table 11.3 on 345. And then that table just has a little bit more descriptions of what each of these are. Look at that at your leisure. Walk through that. And then this is on page 347, and it's organizational factors contributing to fraud. And this is just, if you look at the key, the gray area is 2009 and the blue is 2003, and it's just the differences of what contributes to the risk of fraud. So the biggest jump between 2003 and 2009 is the third one down, inadequate oversight by directors over management. But the biggest one is inadequate internal controls, which is stuff that I talked about before.
Okay, what happened right before 2003?
Okay.
Sarbanes-Oxley. Immediately before that, tons of frauds were created. Sarbanes-Oxley. Or financial statement misstatements. Yeah, whether it was fine or not. Debatable, I suppose. But anyway, so what happens every time that we go through a cycle of frauds? Government gets all involved. We lose a little bit of our freedom as a profession, right? A little more regulation of us. And we all get really, really careful. And our clients get really, really careful too, because they're in trouble too. And then what happens over time? 6 years, you guys. Look at that. And just a pretty nice chart. Is there more collusion between employees and third parties? More collusion between employees and management? You know, a little bit, but what is there really going on? Like you say, it's that third one down there, and actually the two above it pretty good, huh? Pretty healthy increases. What will stop this problem? A whole bunch of frauds, and then we'll get serious again. But then maybe we'll be government employees at some point too, you guys. If anybody had suggested to me that Public Company Accounting Oversight Board would exist instead of auditing being regulated by the AICPA, it's now regulated by an independent body from us. The closest we can get to being regulated directly by the government, becoming government employees, effectively.
Oh, that government pension.
Yeah, but you wouldn't like the government salary.
Yeah.
You want to make $100 a year, in, 5, 6, 7 years, or do you want to make 45? Government pension's real nice, but retirement's a little different. Yeah. So anyway, but it's all right. There's nothing wrong with working for the government, of course.
Okay, so if the auditor discovers the risk of material misstatements due to fraud, there's 3 different responses, which include change the overall conduct of the audit, design and perform audit procedures to address fraud risks, and design and perform procedures to address the risk of management overrides and controls. And then the paragraphs after that just go into more detail of each of those. For change the overall conduct of the audit, auditors are required to incorporate unpredictability in the audit strategy, which helps lead to them doing more testing. Design and perform audit procedures to address fraud risks. The big thing in that little section is that auditors should consider management choice of accounting principles, so like why they value their inventory the way they do, or because that'll help determine whether or not there is a higher risk of fraud based on why they're doing different principles, especially if they change principles in different years. And then design and perform procedures. The 3 things in that are examine journal entries and other adjustments, review accounting estimates for biases, and evaluate the business rationale for significant unusual transactions. So if something major happens, you need to know why and why they did what they did to determine whether or not that increases the risk of fraud.
You got to get the idea of this. You don't tell the client what your audit procedures are, ever, right? It's a black box. They hire you. You can't tell them what you're doing. You don't tell them what you're doing. You're not when you're asking for materials from them. You don't tell them what you're going to use it for. You don't tell them how you're going to check things out. You don't tell them what you're looking for. Because you don't. If they were dishonest, you wouldn't want to be game the system, right? So you don't give it all away. A number of years ago, before all the frauds, before all the WorldCom and all that stuff, Enron and so on, and therefore, of course, on Exoxley, I would have partners from CPA firms come in and talk to our students back then, and join classes, and still do occasionally. But anyway, on several occasions, I had a partner from a Big 4 CPA firm come in and say, well, nowadays, what we do is we get together with the client, and we determine our scopes for materiality, and we determine what the risk areas are in the audit. Now, do we have conversations with the client about where the risk areas are in the client? Yes, what they think the risk areas are for their business risk, right? For their inherent risk, for their control risk. Oh, sure, you have conversations with them. But do you talk with them about what procedures you're going to do for risk assessment? Do you talk to them about what your perceptions are of risk? Do you talk to them about scopes for materiality? How does that one use away? Right? No. What if your client knows? And by the way, they don't do that anymore. The big move towards that. Oh, we're on our client's side. We're cooperating with the client to get a good audit. Yeah, you want to cooperate with the client to get a good audit, but you don't want them to be able to keep you from getting a good one by telling them what you're going to be doing. Okay? So the firms backed off of all of that. And I think redeveloped more professional skepticism as a result, right? Does it make the audit more expensive and more difficult to do if you don't have as much communication with the client about what's going on? The answer is yes. Might it make it a better audit? I don't know. Right? You got to use your judgment on this. It certainly is easier to have the client explain everything to you than try to figure it out yourself. There's no doubt about that. But be careful, they're not legal. That makes sense.
Okay, so then the next several pages are just specific areas of fraud, and then they go into excruciating detail of each of them.
And I want you to memorize all of it because I wrote some special questions that have the infinite detail. But know what an example is. Somebody made a comment before class. After you read a few of them, that's enough, right? I got it. Leave me alone. Yeah. So just no matter what area I give you, and as we go through, we're going to do all these different cycles. Guess what? They're going to do all this stuff again, right?
So then, auditors are required to identify revenue recognition as a fraud risk. It's one of the easiest things and one of the ones where it hits the most, where like they record revenues before they're supposed to be reported, or just create revenues in general that shouldn't be there. And then with inventory fraud, taking things that you shouldn't have, or saying that you have higher inventory than you do, or vice versa.
Isn't it funny they do revenue and accounts receivable, because obviously it's debit accounts receivable, credit revenue, right? That's fraud. If you want more. If you want less, it's smoothly it's the reverse of that. But what you could do is you could credit unearned revenue, right? Effectively debiting revenue. Obviously, if you want to reduce your income. Why don't they say inventory and cost of goods sold? Because it's both, right, guys? I think they should, right? Because why do we care about inventory so much? Because you can easily manipulate income. Same reason that we care about accounts receivable, because you can easily manipulate income with it, right?
And then purchases and accounts payable is kind of the same as revenue recognition, it's the opposite. And
By
then,
the way, what is purchases tied to? Inventory and cost of goods sold together. What does purchases go with?
accounts payable.
Well, yeah, but in terms of income, what does it go with? Purchases is part of what? Cost of goods sold. Yeah, so it's the same thing. Inventory and purchases are doing the same thing, right? Yeah. So you could have if you're a perpetual if your inventory system is perpetual, which of those accounts don't you have? Purchases anyway. Yeah. If you're periodic, you have that account, but it ties right to inventory, which is cost. It runs the cost of goods sold. So they all tie together. And accounts payable, an error in accounts payable can be an error in cost of goods sold, right, guys? Pretty easy. You fail to debit inventory, credit accounts payable. Right?
It's just stuff related to the inventory. So responsibilities when fraud is suspected is the last part of this chapter. And it says in that first little paragraph that 47% of frauds are detected through like a tip with a hotline. So hotlines do work very well, especially if they're anonymous, because then you don't necessarily aren't looked at different for reporting it. So then when fraud is suspected, the auditor gathers additional information to determine whether it actually exists, and if it does actually exist, then there are specific steps you have to take. But if you find an area that has fraud, you have to be more scrutinous of all the other areas of the audit, because then there could be fraud in other areas as well. And then this graphic is just basically like the differences for how auditors can figure out about schemes, whether or not there's, and it's like with or without hotlines for each of those.
Which do you think might be cheaper to implement in your company? A hotline tip, getting tips. You have to have a culture where surveillance and monitoring. And then when you think about that, which is more effective? Wow. Gee, it's nothing. We have a hotline at Bellarmine too. You can talk to the president directly. That's not a hotline. But if you wanted to complain about theft by the president, I'm not accusing you of stealing. Okay? But what if you did with a system like that? The president is committing the fraud, and the hotline goes to the president. And lots of CEOs love that. Say, oh, I'm in the loop, and I'm directly communicating with my folks. Who should control the hotline? The audit committee. Absolutely. Through the internal auditors, perhaps, right? So the internal auditors, by the way, who do the internal auditors report to? The audit committee, just like the external auditors. So then the internal auditors will hopefully be able to report if the CEO or CFO or you name it, marketing VP or something, are doing illegal, unethical things, right? You want to set it up so that people would be willing to do that. And the nice thing about a tip line is what? It can be anonymous too, right? Because most employees would think, what? Oh, yeah, I'm going to talk about what the president's doing. Yeah, sure I am. Well, if you make it anonymous, and it really is, maybe they would. Right? By the way, somebody always knows. Somebody always knows. Right? What do police rely on most to solve murders? What's that?
Witness tips?
Yeah, tips. Absolutely. Somebody saw something. Somebody heard something. That's how they find it. That's how they get it, right? That's how you do police work. So why wouldn't we use tips? I guess we should have tips to the auditors. No. People probably think that's some weird. Call Pricewaterhouse and tell them what's going on in my company. But actually, sometimes that happens. It's a famous fraud. The auditors were told, the auditors were out of the client. And people working for the client said, hey, you have a good relationship with the client, right? The people that are working there said, this looks funny to me. So there you go. Big fraud. Right? Fine.
So when you do find misstatements that have the potential for occurring because of fraud, there's different things that you can do, specifically with making inquiries. So informational inquiry is just to obtain information that the auditor doesn't normally have, and it's asked of management. Assessment inquiry is to corroborate or contradict prior information that the auditor is given. Interrogative is used to determine if the individual is being deceptive or purposely omitting disclosures. So those are the three types of different inquiries that you can make based on what information you have and the risk of whether or not there was fraud. And then evaluating responses is geared more around your listening skills and evaluating what the person that you're inquiring of, how they respond. So if they're looking at you in the eyes and if they look like they're paying attention, then it's easier to rely on those. Whereas if they're shying away, then they probably have something to hide. And that just goes along with observing behavioral cues. Pages 356 and 357 have two different tables for verbal and nonverbal cues to just look for, and then what the potential implications of those are, based on their speech patterns and their body language.
These are pretty good, aren't they? You could read through those. Page 356. There's not a slide for these, is there?
Okay.
Is there up there? Oh, there is. Can't read it. On page 356. Extensive use of modifiers, generally, usually, often, normally. And then they say down below, filler terms, well, tell you the truth. Huh. It's interesting. Those kinds of things might be a sign, right, that it's okay. Tolerant attitudes. Dishonest people are often tolerant towards someone who may have committed fraud. Too forgiving. Too forgiving makes me really nervous. Yeah, well, it does go backwards. Yeah, I caught the kids cheating, and they've probably been cheating all the way through college, but I feel sorry for them. So, okay. What? So then I guess if they rob a bank, it's kind of like, well, children make mistakes, It's okay. Yeah. I don't think you want to go quite that far, guys. So You know, if people show that, you know, anything goes, it gets back to that culture thing, right? Anything goes in this organization. Yeah, I know they did that, but it wasn't a material amount they sold, right? You know, so, or we're not following the internal controls, but it doesn't really matter. It's not a big deal. Just a lax attitude. I like this one reluctance to end the interview. They're trying to deceive you, so they want to keep on going until they can convince you they're telling the truth. That's interesting. Maybe that's an interesting giveaway. Usually people want to get rid of you, right? I want to continue on. How about if nobody wants to talk to you? They hide all the time. They're just always too busy to talk to you. But all these things, these nonverbal cues are really work. You know, and you have to look at, well, what's personality? You know, how quiet are they? What is the person like? You know? But if they act a lot different around you than they do when they're with their coworkers, that's kind of strange, don't you think? Some people have trouble with authority figures and they think you're an authority figure. Although it's hard to be anybody who thinks you guys are authority figures, but they kind of do when you put on a suit, huh? Right? You show up, you know, the auditor and stuff. So you need to break those barriers down with everybody so you don't get this type of stuff convert people. But then if you do, it's kind of weird. It always makes me nervous when somebody can't tell me something. It's a secret. Really. We have confidentiality here, but it's a secret. You can't tell me. What happens if you tell me? You know, it's either they don't know the answer, or they don't want me to know. One or the other, right? So you kind of get that across too. I need to ask about everything you know about everything.
So then, the last few things that it talks about other things that you can do if you find fraud besides doing inquiries is using like software analysis to help determine if there actually is fraud. Expanding your substantive testing if you find areas that have heightened risk. And I touched on that before. You can even use specialists if there's certain areas that you're not super comfortable in that require a little bit more like obsolescence areas. You can use specialists to help assist you. And then if you determine that fraud is present, then you need to discuss the matter with usually the next level of management, and then if they have them then go up the ladder, but don't just straight from the top. But then you also need to tell the audit committee about it as well, which is what I said before.
We can't leave early. That'd be terrible.
Yes, you can.
No, it's not too bad. Go to page 360. You guys look at these? Did you look at them? Page 360 are multiple choice questions from the CPA exam. So seeing as we do have a few extra minutes, let's go around and let's have people work it and tell us why they think that's the answer. That'd be fun. I think that'd be fun. Come on. You're on the hook. You don't have to go first. She's putting all the stuff away. No, you can't do the first one.
No, I'll do
You
it.
can't leave. You have to do it. Quick. I don't care. That's why you can't do it. Do the first one. I don't know any of the answers, so what I'm going to do is I'm going to turn off that light up there, and then I'm going to pull the answers up here on the screen. So nobody else look at the answers, because that's not fair. Okay, that would be dishonest. Yeah, read the question out loud real quick. You have to leave. Hurry up.
Because of the risk of material misstatement due to fraud, the fraud risk, an audit of financial statements in accordance with generally accepted auditing standards should be performed with an attitude of one, professional skepticism.
Was that a little too easy? What are the other ones? Did they at least try to get you sucked in?
Objective judgment, impartial conservatism, and independent integrity.
Does everybody agree that is the answer?
Yes.
Yeah. Because they just beat it up in the chapter. Will you know that's the answer when you take the CPA exam?
Yes.
Whenever that is? Yeah, why not? How could that ever go away? And if you take this stuff, thank you very much. That was very nice of you.
Do you want this? You're going to put,
That's my book. Are you going to steal it from me?
well, I was going to put it with your stuff if you
Oh,
didn't
you
want it
better
up there.
stop it.
No, I'm going to steal it.
So somebody want to do the second one?
Which of the following characteristics is most likely to heighten an auditor's concern about the risk of material misstatement due to fraud in an entity's financial statements? The entity's industry is expecting declined customer demand. Employees who handle cash receipts are not bonded. Internal auditors have direct access to the board of directors and the entity's management. The board of directors is active in overseeing the entity's financial reporting policies. I would probably go with one. The industry is expecting declining customer demand. Because two would be the other ones, but cash receipts, generally, those aren't material, they're pretty small. So it says material misstatements, so I would go with the industry's declining customer demand, because I think fraud there.
You guys think you agree with them? These are pretty good, aren't they? These are a little closer. The other one seemed pretty obvious, I think.
Yeah.
But
Yeah.
I agree.
You agree? You agree?
we got one agreement. Anybody disagree? Like another one? I'm looking them up, but I only have chapter 10. I didn't put chapter 11 out here. I can't look them up. Terrible. Okay. Anyway, so you guys think so?
Control.
What's that?
Bonded would be like controlled, right? Like restrictions.
Oh yeah, they're bonded, so if they steal, you can be covered from an insurance company.
Oh.
Yeah, it's insurance. It's a bond, insurance bond. Yeah. So, yeah. I think the declining customer demand is scarier than those other things. Not bonded is not a good thing. You know, you want it to be bonded, but it's smaller. It's individual, isn't it? Internal auditors have direct access to the board of directors and the entity's management. Let's hope so. Right? That one's pretty easy. The board of directors is active in overseeing entities' financial reporting policies. Let's hope so. Right? So those two are pretty easy. So it's just down to the other two. And you're right, two wasn't as big a deal. By the way, on the CPA exam, the questions will be numbered, and then the responses are A, B, C, D. And this is weird that they switched that around. I don't know why they do that. So you want to do another one? See?
It's not play person, you know, I do this one.
Oh, is that right? Yeah.
Great.
Go. Jump in.
Which of the following circumstances is most likely to cause an audit to increase the assessment of the risk of material misstatement of the financial statement due to fraud? Do I have to read all the answers?
Likely to cause, no, I don't have to just go with you guys. Whatever you decide.
I will go for number
That
two.
will remind me to put the answers out there. Oh, I'm not going to put those notes out there for you. You know why?
That's fine.
Because they're exactly the same as the PowerPoints. I'm not kidding. It's like it's an outline for the PowerPoints or something. It's just an outline. So I looked at it again, one of the chapters, and I'm like, I'm wasting my time to put it out there.
I'll go for number two.
Unusual discrepancies exist between the entity's record and confirmation replies. How about that one, guys?
Yeah.
That's kind of scary. Property and equipment are usually sold at a loss before being fully depreciated. What should they do? It's being sold at a loss before being fully depreciated. Depreciated before. Well, maybe their lives are too long because they're selling them before they fully depreciate it. So maybe their lives are too long, but that's an estimation issue, right?
Yeah.
And then at a loss instead of a gain, it might be what? They didn't depreciate enough, right? So is that kind of a problem? Yeah, that's kind of a problem, okay? Is it as big a problem as two? I don't think so. Monthly bank reconciliations usually include several in-transit items. Oh, for God's sakes, it's a bank reconciliation, of course they do. Deposits in transit and outstanding checks. I bet they include thousands of them in any company of any size whatsoever of outstanding checks, right? Okay, you've done these bank reconciliations with a huge number of checks outstanding? Yes, okay, yeah. It's amazing, isn't it, how many checks they can write the last day of the year. Clerical errors are listed on a computer generations exception report. Well, so what? That's exactly what they're for. So two of these were, I don't believe these are CPA exam questions. Somebody want to do D and I'll let you out of here.
It's four.
It's four, let's leave, okay. Which of the following statements reflect the auditor's responsibility to detect fraud? Should design the audit to provide reasonable assurance of detecting errors and frauds that are material to the statements? I like that. What's wrong with the other one? The auditor is responsible for detecting employee errors and simple fraud? No way, right? And not for employee collusion or management override? An auditor should plan the audit to detect fraud caused by departures from GAAP? Nope. An auditor is not responsible for detecting fraud unless the application of auditing standards would result in detection. Yeah, these are, you know what? These are really easy. Yeah. I wanted to give you those on CPA. I did not give them to you on that exam. Yeah, nah, I'd never give you that.
Can you put the check mark?
Yeah, I'll get 11 out there. I apologize for that. I'll get out the rest of them. I guess I thought that we were only doing 10 on the first two tests or something. I don't know what I thought.
Yeah, I was gonna say, he knows your dad really well.
Yeah.
Yeah, I saw the game. My team. High up there. Your dad's basically like CSI. It's like crazy scary, like forensic accounting. It's like that. Yeah.
I just wanted to make
Yeah.
sure.
If you guys go,
Well, he has put in I got his classes in. Because we're gonna get out all day.
oh,
Right now, we're gonna play the last game. Are you working Monday? Yeah, I gotta work extra on Monday, Tuesday, because I'm taking off on Wednesday, Thursday, Friday.
Alright, well, we'll just talk about that.
But Lord knows that, right now, I just need to make sure after lunch, we'll play the late game on Thursday. We have the three, they haven't released it, but last year it was at like 8 o'clock St. Louis time. Well, yeah, that's what I'm saying, we'll have all day, because we don't have to sleep all day. You know, we're talking about the rest of.
Alright.
no comment.
We don't, I don't
Share
think
with you.
that. We'll play the late game on Thursday, that's what we're talking about.
You get a triple me.
Is he, she knows Arlington? Is he down there? Well, we'll play the late game on Thursday, so we'll have all day.
That's good. Yeah, if the two of you are to that point, talk to Grant
Okay.
and just say, look, do tell
Well,
him.
he said.
We're gonna do it ourselves, and we'd really rather he didn't join us at this point, because it's too late. We've done too much.
Grant said he wanted it by Friday, but at the latest by Monday.
Yeah.
And we were kind of like waiting on Michael, so I was just gonna ask if there was a way to get it by Monday.
Yeah, and if you can't get hold of Grant, just do it and get it to him on Monday.
Okay.
And say, I talked to Keith, and he thought it'd be better to have it done than not.
Okay.
Yeah,
All right. Thank you.
good. He's gonna work with you on it anyway if it's all screwed up, right?
Okay.
Ha ha ha.